Okay, well, we might kick things off. Hi everyone, Luke Van from Channel Capital here, and I'm very pleased to welcome you to the fixed income component of our virtual asset allocation series. We might just bring up a disclaimer slide for everyone to have a look at while I'm speaking. I guess that fixed income has often been thought of as the least popular asset class, the least sexy. I think it's quite telling that out of all the events that we're holding in this series, this afternoon session has actually been it's actually attracted by far the largest and broadest audience of all. So I guess for me that's really a reflection of the extreme position that we find ourselves in today in terms of debt levels, interest rates, and the outlook in general. So if we just take a step back for a moment to set the scene, I guess traditionally the composite approach, where managers are given free rein over the breadth of the fixed income universe, it's really been the accepted solution for fixed income portfolios. And I guess that's really resulted in an almost set and forget type mindset. That said, with the income in fixed income almost non-existent today, and the lack of defensiveness of certain subsectors having recently been laid out to bear, we've found that many investors are now rethinking how they can approach fixed income allocations in order to ensure that they remain fit for purpose. So in the session today, we're really going to try and unpack some of the key elements of the composite bond portfolio, and I guess look at some of the alternative ways that investors can optimize allocations using specialist strategies and perhaps be a little bit more precise around how their portfolio is constructed. So I'm very pleased to be joined today by three of the doyens of fixed income markets in Australia, representing the traditional high-grade government bond space is duration expert and CIO of the award-winning Jamison Coupe Bonds, Charlie Jamison. For those of you who don't know Charlie, he's regarded as one of the foremost experts in duration management in Australia. Prior to founding JCB, he was head of fixed income, currencies and commodities at BAML, where he established himself as one of the firm's top traders. He has more than 20 years of experience in fixed income markets and has managed portfolios to a range of crises and market cycles. Charlie and the team at JCB offer a suite of strategies across the high-grade government bond space, including domestic and global beta strategies, as well as an absolute return product, which aims to deliver cash plus 2.5% returns consistently with low volatility, regardless of the direction of interest rates. Alongside Charlie, representing the secret asset class of private debt, we're very pleased to be joined by the most experienced private debt investor in Australia, Bob Sahota. So Bob is the co-founder and CIO of Revolution Asset Management, a specialist Australian and New Zealand private debt boutique. In just over 2 years since opening the doors, Bob and the team have raised commitments of around $1.3 billion, with investors including some of the most prominent institutions in the country, which we think is a genuine reflection of the quality of the team and their offering. Prior to founding Revolution, Bob was head of fixed income at Challenger for more than 12 years. He grew their fund from 1 billion to 9 billion in that time and built out their private debt strategy from scratch. Bob's the only investor that we know of who's managed an Australian private debt portfolio through a full cycle, including the GFC and now the COVID crisis, without experiencing a single default. Bob and the team at Revolution offer a unique access point to the domestic private debt markets, covering LBO, ABS and real estate debt. They take a very conservative and measured approach to this space, looking to preserve capital and deliver returns of cash plus 4 to 5% per annum through a cycle. Now, for those of you who do know our two panelists today, I think you'll also know that they happen to be two of the most outspoken and vociferous individuals in fixed income markets. So when we were putting this session together, we knew that we needed an especially talented and astute moderator to keep them in line. So I couldn't be more pleased to have Sue Wang on board to ask the tough questions and hold the guys to account. Sue's had a distinguished career in investment markets. She's currently senior fixed income portfolio manager at Mercer, where she has responsibility for Mercer's domestic fixed income portfolios. Prior to that, she led Mercer's fixed income manager research efforts in the Pacific region, chaired the Australian Ratings Review Committee, and served as an investment consultant, providing specialist fixed income advice to a range of institutional clients. So we really couldn't have anyone more qualified for the job today. And aside from quizzing our panelists, I'm also really looking forward to hearing some of Sue's own thoughts around how investors should be thinking about assessing various fixed income managers, how they can construct and blend portfolios in order to achieve their desired outcomes. I did also just want to briefly mention, for those less familiar, Mercer's a global leader in superannuation investments and human resources. They're supported by a team of 25,000 colleagues. Mercer has over $300 billion in assets under management and $15 trillion in assets under advice. They're absolutely seen as a beacon for global insights, thought leadership, and product innovation for businesses in the Pacific region and globally. Now, that was quite a mouthful of an introduction. So on that note, I'm going to stop there, and I might hand over to Sue to kick off proceedings. So thank you, Sue.
Okay, thanks for that fantastic introduction, Luke. Hi, everyone. As Luke indicated, my name is Sue Wang, and I will be moderating the session today. I've been involved in fixed income markets for almost 20 years, can you believe? And both on the consulting and also the asset management side. In my time at Mercer, which is in the double digits now in terms of years, I've gotten to know both Bob and Charlie quite well. First in my capacity as a fixed income researcher, and more recently my capacity as a portfolio manager. I think it's fair to say, for those who know Bob and Charlie, that they are pretty much at the opposite ends of the spectrum when it comes to fixed income investing. And as such, I believe they are really well placed to provide a well-rounded view of the asset class for us today and answer some of the really difficult questions that many, many clients have been asking. So without much further ado, let's get going. Let's kick things off with a discussion around liquidity, which I think is key to many, many people's concerns and thoughts at the moment. Starting with you, Charlie, if you don't mind, can you maybe talk through how you think about liquidity? What is its value? And why is it important for a portfolio construction perspective?
Yeah, thanks a lot, guys, and thank you, Sue. Look, liquidity, I guess, very topical over the course of this year. It's something that, we've been talking to investors about right across our journey, and often they kind of yawn and stare out the window. But there are these periods clearly in markets where it becomes tremendously important, and no more so than I guess we saw in March and April, when a lot of things become very illiquid very quickly, and you realise that under that kind of environment, a lot of things start to behave very differently than you might have thought they would. But the major tenet of liquidity, I guess, is it gives you wonderful portfolio optionality. So, through March and April, where a lot of listed kind of credit instruments started to jam up, a lot of funds, and I guess we're talking about subsector specializations in fixed income, a lot of funds that had that composite approach where government bonds were mixed in with traditional corporate credit bonds, also had a lot of problems in terms of raising liquidity. We noted a lot of sell spread extensions where fund managers tried to protect the liquidity that they couldn't receive on the credit side. And so the whole allocation didn't work very well for many folks. And I think, you can see in those periods of duress, certainly some people have liabilities that they need to service. Others want optionality to buy deeply discounted assets, where they feel that the markets are pricing in outcomes that are not going to be sustainable, or certainly, great value is on offer, whether there's hedging requirements, whatever that might be. Liquidity is such a paramount aspect of a portfolio, and certainly something you want to be in receipt of. It's not much fun when you do lose it. I guess with liquidity in March and April, one of the ironic things is that equities remained liquid, whereas a lot of corporate credit debt didn't, and really did freeze up quite considerably until central banks came riding over the hill with their enormous white horse and excess liquidity provision and that backstop of everything. So we work very hard, I guess, with our funds to make sure that we do provide those liquid solutions. We experienced tremendously large redemptions through that period, which wasn't much fun for the bond manager, but was wonderful for the clients. They've done really, really well with being able to access that liquidity quickly, with being able to take it off and deploy it very quickly and capture those opportunities you know, whilst also having an asset class that has zigged when other things have zagged. And that's, you know, I guess that traditional role of bonds and high grade bonds, particularly at those points of stress where you do have that additional optionality and that volatility dampener, and you really can sit back and you know, manage a tactical asset allocation and make some choices depending on how you see things. And so we just think that it's such an important part of portfolio construction and something that shouldn't be forgotten on investors to have that optionality. I guess in the good old days, a lot of folks had cash to play that role in some way, shape or form. But now as we find the world, you know, income is such a difficult thing to generate, be that in fixed income markets or even through many equity instruments, you know, where dividends are unstable or capital prices are very, very high. That income componentry is really complex. And I guess it's a really good time to be breaking it down and working out how can we put the jigsaw puzzle together a little better to meet on all those portfolio requirements and make sure that we get to the totality of portfolio outcomes that investors, we think, would seek.
Okay, thanks, Charlie. And Bob, as a specialist manager in, I guess, in arguably the much less liquid end of the Australian fixed income spectrum, could you care to share your thoughts on liquidity?
Sure, Sue, and welcome everybody to the webinar. Very rarely do you find a credit guy like me in violent agreement with a rates guy like Charlie. So I can't agree any more than what Charlie said about investment grade credit. And it really comes down to this alchemy is what I call it. You can't turn lead into gold. So what people have been traditionally thinking was, yeah, investment grade is liquid. And it is liquid in normal markets. But at the time when you most need it, you need it to be true to label. And really through the crisis of COVID-19 and the violent dislocation that we saw, these types of strategies became completely illiquid. So what do we learn out of that? So, you know, you want to stay liquid in that part of your allocation that is truly liquid, be that government, semi-government bonds, be that repo eligible securities like senior bank paper or AAA rated mortgage-backed securities. Everything other than that, rely on a broker standing in the middle who's got increasingly higher capital charges and doesn't have a trading book to speak of, to then be able to find someone to buy that security in the secondary market. Now, when everybody's heading for the exit gates, guess what? There's no buyers. And that's why the sell spreads had to go wider on some of these investments in investment grade at a terrible time for these people when they're looking to either rebalance or gain, you know, liquidity out of their portfolio for their own redemptions. So what do we learn out of that? Fund structure is extremely important. You need to understand what the underlying investments are and match your fund structure so that you don't have a gun to your head to go and sell things when they become illiquid or dislocated. So in private markets, and private debt is what we do at Revolution Asset Management, we've got a fit for purpose structure that says that in times of stress, we actually see that as being a very interesting time for us to use our patient capital to take advantage of those dislocations and actually gain much better spread, better yield for the same unit of risk. And that's exactly how we managed through that period. And that presented some wonderful opportunities for us. But it was a very poor experience for people who had thought, we'll go along with this investment grade strategy, pick up a little bit of carry, but when they went to get their money back, they'd probably given away the last 3 years of their so-called illusionary alpha. And that's I think what everybody should bear in mind, that it really should be a bifurcated strategy rather than mix it all together and hope for the best.
Thanks for that, Bob. Just shifting on to another key cornerstone principle of fixed income, which is really yield. And I think we can all agree on this call that there's not a lot of it left in fixed income markets today. And it's presenting a real conundrum for most investors and resulted in some perhaps stretching into areas they shouldn't be investing in. How should investors be thinking about, yield and income in this environment? And how can they try to extract a reasonable income or yield through their defensive assets? I think let's start with you again this time, Bob, if that's okay.
Sure, thanks, Sue. I guess the search for yield really is one of private debt, in particular. Our strategy and strategies like ours offer very good levels of income. But the caveat really is you need to find a manager. Manager selection becomes extremely important because you're in illiquid assets. Once you're in, you can't get out necessarily. But through the fullness of time, there is actually liquidity because you've got a legal final maturity date. So if you pick a manager that's got a credit discipline, can actually sort through the kinds of industries, the kinds of businesses that can actually weather a cycle, you can end up generating the kind of income, and in particular in Australia and New Zealand in private debt, the income is much wider than what you'd find in other places because there are very few institutional investors in private debt that have got to a critical mass here in this country. So we're still at the infancy where the illiquidity premium is very, very high. And in the COVID period, it actually expanded by 1 to 1.5% in the asset classes that we manage. So the income component of that is extremely attractive. But the caveat is if you have defaults and you have losses, that flows your whole out of all of your yields. And if you don't return the capital, then that's the end of your strategy. So I think the benefit of skill and experience in managing through those sorts of cycles really comes down to manager selection is kind of the key.
Yes, and you have certainly touched on something which we'll come to soon, which is, I guess, the capital security element of the asset class we're all talking about. Charlie, just throwing to you now on the yield question. You're investing in an asset class that is increasingly looking like it's heading towards a zero or negative yield. What are your thoughts on how clients can extract income and yield where possible?
Yeah, look, I mean, it's dark days in terms of extracting yield. We know the world over that rates are at zero or negative, really in the developed world, and yields are very, very low. So the sad fact is that incomes that we have lent upon in years gone by are simply not going to be there at a standing starting level, which means that managers are going to be asked to work a lot harder, and alpha generation is going to become very, very important. Now, the one thing I would kind of temper in that comment, though, is that there is still some additional runway left for Australian government bonds. They are positive yielding. In historical terms, they're actually statistically cheap. Now, I'm not going to find anybody that will agree with me on that. But if you look at where they are versus the RBA cash rate, they are actually a little bit cheap, which is quite staggering. And so when we've looked at some of these other markets that have gone to zero or negative yields over time, markets like Germany, Switzerland, Japan, you'll find that the government bond complex as a beta-only allocation, so as a Vanguard strategy or a BlackRock, ETF, all these types of things, have historically still generated slightly positive returns, sometimes a little bit more. But even with negative yields and negative rates at the central bank, there has been some positive return by virtue of the steepness of the yield curve and what we call a roll and carry strategy. In Australia, we're starting much further back on the grid. We've got substantially positive yields versus some of the international markets, and we have the steepest bond curve in the world. So when I look forward and think about how our beta solutions will perform through time, I still believe there's plenty of runway left, and there will be good returns. We're now operating under the edict of a quantitative easing program. We're going to start with $100 million, but Governor Lowe said we'll happily extend if we don't achieve what the RBA are looking to achieve, and that is lower yields and a lower currency. So in many respects, whilst the lemon has been very much squeezed, and is the juice worth a squeeze, as they say, there is a little bit more to go, particularly in Australia, and where we're finding such difficult problems in terms of generating income. I think with something like this, and we'll no doubt talk about the capital guaranteed componentry to it, it still makes a lot of sense from a portfolio construction point of view. I don't know that my marketing pitch will be as easy when we do finally go to negative yields, and I certainly believe that will happen in the years to come. New Zealand, Canada, the Bank of England, they're all going negative next year, and Australia will stand out a little bit. I've been very critical lately of the RBA that keeps telling us that they have this vision for their policy, and they keep backtracking on it and changing and doing things they've never said they would do, and they've done it consistently over the last 5 or 6 years. And of course, the iteration of it at the moment is that we won't do negative interest rates and we're not interested in it. But when everybody else does them, invariably it will come up as a conversation point soon enough. So we are still talking about assets that have got reasonable yields in the context of where we are in the cash rate cycle. But granted, I fully appreciate that investors, when they look at it on a yield to maturity basis, don't see anything like the yield that they've seen previously. and they're going to be much more reliant upon manager skill and the like to extract additional return and make sure that they can enhance that yield or optimize that yield through time by precise asset allocation and sensible risk management.
Yeah, and Charlie, and I would certainly agree that with zero no longer the lower bound, and certainly hasn't been a lower bound for some time now. Our market in Australia certainly looks like it still has a little bit of a runway, and we still have a reasonably steep curve. So I think there's still some juice to be gotten out of there. Switching gears again slightly, guys, if you don't mind. Capital security. Bob touched on this a little bit earlier, but it's often thought of by investors as a completely non-negotiable element of fixed income. Most investors who invest in our asset class, they don't want to stomach any losses. Now, credit quality is a typical metric that's commonly used to indicate the level of risk of capital loss. In both your views, is this a consideration important when you're managing money? And is there more to that equation than simply just credit risk? Maybe Bob, it's a bit more pertinent for your asset class, I think.
Sure. So the one key thing that we would always talk about is security, and what we mean by security is having a basic charge over the particular business or entity or group of assets that we're lending against. So having been seen secured and many times being secured in the capital stack comes to the fore and comes to the rescue when you have a dislocation. It means that you've got all the equity that a sponsor is actually provided in that capital structure as your shock absorber for any losses before you suffer any. So typically investment grade bonds are generally done on an unsecured basis. And you saw how that played out for Virgin bondholders through that COVID-19 period with a handful of cents in the dollar back. That's sort of the benefit of being secured. And how else do we sort of come at our strategy to make sure that we fit within the defensive part? Because today's topic is all about asset allocation and fixed income. It is really avoiding pro-cyclical industries. So avoiding those that through a cycle like advertising, media, tourism, hospitality, property development and construction. All of these things, some people have got strategies around saying we're private debt managers, but we're involved in property development. I would proffer the idea that you're probably more in the alternatives bucket than being in the traditional fixed income defensive alternatives bucket that we typically target. What we like is industries that through a cycle are extremely stable and robust, be that healthcare, consumer staples, be that in mission critical software. And these are the kinds of industries that we've really focused on because we know that, the markets are always in cycles. And the best you can ever do as a fixed income investor or a private debt investor is pick up your coupons as they come, your interest payments on the loan, and get your money back at the maturity of that loan. And if you bear that in mind in every investment, you'll be able to deliver the kind of return that you promise your investors with that essential feature of capital stability.
And Charlie, I mean, like I know your playground is predominantly very high-grade government bonds and semi-government bonds as well. But anything to add on, I guess, on the capital security and the credit element?
Yeah, look, I completely agree with Bob. I mean, I guess one of the things that's been staggering about this little mini cycle that we've gone through and fast forward, and we'll continue to go through into 2021, is that when we have had problems with investment grade credit or investment grade credit that gets cut to lower grades, is the recovery rates have been horrific. So Bob pointed out Virgin cents in the dollar. All of the big US credit defaults this year have been cents only in the dollar, where ordinarily they'd be 30 or 40 cents. There are a handful of cents. And it's when we look at the markets, and I think this is why this is an interesting conversation to have with myself and Bob, who are really so bifurcated in what we do, that middle ground that we don't touch has become very structurally unstable. So, since the GFC, we've seen this enormous girth of BBB rated, just investment grade credit issuance, but into a system that simply can't process it at anything other than a primary level. And so episodes like March and April see this catastrophic collision where people go for the door becomes a keyhole, and nobody can warehouse this stuff until it vastly reprices. And I think that's why some of this listed credit space we've been very critical of, as Bob has been critical of. And I do completely agree with him. The security that he holds over the lendings that he makes is absolutely paramount in that. I guess it's not something that I need to worry about as much. Sadly, from my point of view, governments can always tax their citizens. And when you have high quality governments such as we do, the credit quality is not really ever in question. But yeah, I completely agree and echo Bob's comments.
Thanks, Charlie. And switching gears one more time, guys, if you don't mind, I think another core function that a lot of our clients use fixed income within their multi-asset portfolios is to diversify. And I know that certainly we at Mercer, we've been splitting fixed income into what we call defensive versus growth fixed income for some time now. Defensive fixed income, which is what I would consider what you do, Charlie, I really develop market sovereign bonds and the like. And that part of the portfolio is really meant to protect your entire portfolio at times of equity market stress. And whilst the growth fixed income component, such as more sub-investment grade debt and so forth, will typically display a higher correlation to equities, which should help diversify the growth portion of your portfolio away from just pure equity risk. How do each of you think about diversification from a broader portfolio perspective? And what do your respective subsectors add to client portfolio mixes? Charlie, might start with you this time.
Yeah, so I guess we talk to clients a lot about this. I mean, what role should fixed income play for investors? Some investors are income only, some want that diversification sleeve, some are very focused on the capital guaranteed nature of it. And so the diversification element, is really a bit of a choose your own adventure, I guess. It's what other risks are you looking to insulate? Are you looking to put ballast into the portfolio? Is liquidity something that you're, really interested in? If you do get vast changes in markets, is that likely to want to trigger changes in asset allocation and those types of things? Or is this likely to be a program where, we'll drip feed it at every level type thing? So I do think diversification is something that people do need to think very heavily about, because clearly for very young investors, they don't need a whole lot of defensive fixed income such as what I do. Clearly, in a life cycle program, much older investors who can't, afford to go through one of those sequencing moments where they could have a material drawdown in their superannuation retirement pool, need a lot more of that defensive type element where, we know that the markets will do what the markets do. They'll zig and zag around a little bit, but we really run very low volatility type offerings that have always got this resetting nature to them because they're government guaranteed and continuously compounding. So we have that wonderful benefit of time in what we do without any risk in terms of credit quality through time. But yeah, I really do think that that's something that people need to think very carefully about. I guess, with yields being where they are and people, or certainly some people having a little bit of concern around duration and the like, we are seeing, new products come to market, and we've certainly launched one ourselves to try and take out the best of what we do in terms of alpha generation, but continue to provide some income solution with that liquidity, which we just believe is so absolutely paramount, and why we are so selective in terms of the securities that we'll put in our portfolios.
Thanks, Charlie. And Bob, perhaps you can talk about diversification from two angles, please. One is how you think about diversification within your portfolios, being, obviously illiquid holdings where I guess the money good nature of them is paramount to investors. And secondly, perhaps a discussion around how clients should be thinking about your asset class in the context of their broader portfolios.
Wonderful. Great question, Sue. So into the illiquid asset class, as you point out, where it's really a buy and hold type of strategy, it goes against a little bit the old portfolio theory of diversification being your friend. So in Australia, where the market's not as deep and not as broad and not as liquid, diversification equals diversification, i.e. you don't want to have little bits of every deal that comes along, because guaranteed some of them are going to blow up. So what you need to do is have the discipline, the credit skill to actually sift through the universe of opportunities, cast your net broadly, as we do across 3 different markets, being leveraged buyout deals, asset-backed securities, and stabilized real estate funding, to be able to pick from a relative value of a broader universe and then do deals with a higher conviction, where we have a great deal of analysis to back up that through a cycle and through a recession, we've got a great great confidence that we're going to get our money back. So we are more high conviction. I mean, having said that, we're up to 34 positions in our new fund already. on our way to probably north of 50 individual positions. And that's the benefit of being across those different sectors. So I think that's sort of the extent of it, whereas in the US and Europe, you'd have many hundreds of positions in a portfolio because you're actively trading them. That's the difference in Australia and New Zealand. If I move my lens to being more the overall asset allocation piece, where does this fit? We have the benefit of being private side and not being in liquid markets. So we have a buy and hold strategy that really doesn't mark to market. So if we pick the right investments, the only time they deviate away from that par valuation is if you have a default or an impairment. So if you do a good job in avoiding those, this actually delivers you with a very uncorrelated risk for your portfolio. We've seen private debt become a mainstream asset allocation piece across large clients in the US and Europe, and it's become a very established asset class. We believe at the Revolution that this will become, in time, as the market matures here in Australia and New Zealand, a more reliable and more mainstream asset class going forward because of these attributes as the market sort of develops.
Thanks, Bob. Okay. As Luke sort of introduced the session with a bit of a discussion around composite strategies, there is a sense that many investors in our market continue to use these more aggregate or composite styles of management within fixed income. What I'd like to share is that we at Mercer actually disaggregated our fixed income portfolio some time ago now. For us, one of the key learnings from the GFC was the need to disaggregate sovereign bonds from credit, given their very different risk profiles, especially during market crises. Now, this was again the case very much during the COVID pandemic at its height in March this year. And now, whilst developed market sovereign bonds provided a much needed buffer during that period, we all know that the supposedly liquid credit, high-grade credit market became quite heavily correlated with equity markets and due to fairly indiscriminate selling across the board. And so I guess my question to both our panelists today are, how do each of you focus on the specific elements of an overall, I guess, allocation? Why do you believe there is a need to have a specific sort of specialized allocation as opposed to a broader composite allocation? I might start with you, Charlie, this time.
Okay. Yeah, sure. I think I kind of touched on it earlier on, but the major problem, I guess, with these composite style strategies where you trust the manager to allocate, where they believe should be appropriate, is that invariably they just don't make the reallocations when they should. I think we started writing following COVID in January. We were amazed that a lot of others weren't really that interested in speaking about it. But it was around for a long time. I mean, the markets were talking about it for weeks before it really hit that crescendo moment in the middle of March. And we saw so many managers just didn't change their asset allocations. I mean, this was not a plane hitting a building on a sunny morning in New York or an earthquake in Tokyo that comes out of nowhere. This thing was around for quite some time, and a lot of folks didn't. So that's frustrating, I think, for a lot of investors. But it's that coagulation of holding credit and government bonds together, which I touched on earlier on, where the entire fund structure can become compromised as a result, because clearly as the credit market evaporates for that time and there is simply no market to sell into, the fund managers themselves, trying to feather their own nests, invariably blow out their sell spreads tremendously and throw up what are somewhat soft gates around these things. And as a fixed income investor, you lose all of your optionality then, because you have to pay these tremendously egregious sell spreads to extract any kind of liquidity. And so, as Bob touched on, any alpha or, the like that you thought you'd been in receipt of for years prior to that is gone in a heartbeat. So we really just do believe that it's very important to have that subsector specialization, very much like a player on a sporting team. Everybody has to play a different role in a different position. And certainly we know our position's pretty boring for most people. We try and make it interesting, but don't know that we always do. It's a pretty dull product, let's be honest. But at those times, it becomes quite exciting, and it does give optionality to investors. Clearly, they've had very good financial outcomes this year where many other assets didn't. And so we believe that if it is to be viewed in that kind of insurance type characteristic, it's not something you should have to pay a particularly large premium on. We should still be able to deliver some kind of return, albeit these aren't predominantly AAA rated government assets. By virtue, they should be the lowest returning assets in your portfolio in a benign environment. They are the highest quality. They are the most liquid. And so we try and think about it in that context. But I do think that that historical legacy is of that composite styled allocation and this one size fits all, jack of all trade type allocation. That is exactly why Bob and I started our businesses, walked away from gainful employment a long time ago and said, this thing's got to change. And, it's not going to happen overnight, but it's clearly, very structurally flawed. And we've got to build these solutions and put them on the shelf so that investors can have that selection. And once they get an understanding of what we can deliver and how these are going to work in conjunction with each other, we think that it'll become quite compelling. We certainly hope that, people have witnessed that and feel like that after, the episode of March and April.
I certainly don't feel like what you do is boring, Charlie, but that could be because I've only ever worked in bonds. And Bob, I mean, like you've had a lengthy career in fixed income and invested across the spectrum. What made you decide to ultimately specialize, in particular in the less liquid segment that you have?
I guess the reason why I chose private debt is I've always had a passion for private debt. It involves more credit analysis, more fundamental work, more understanding the top down, how businesses operate, how those individual companies within those businesses operate, how do they really go about managing through a full cycle. That to me is a lot more interesting than basically an investment grade bond where you're just doing a little bit of credit work and it's more relative value. And at the minute, you see it becoming more and more marginalized because it's not as liquid as it used to be. So when I first started trading corporate bonds at PIMCO, you could pick up the phone and trade 20, 30, $40 million in a phone call. That was when trading books had, quite a lot of breadth and were able to take on positions right up and down the spectrum. In managing fixed income portfolios for the time that I have, you can see that thematic coming through with global banking reform starting to affect banks, starting to affect life insurance companies, such as Challenger, where I used to work. And so the real runway and opportunity comes from where there is very few players with the skills and experience. And that is Australia and New Zealand private debt. And this is a way that we can generate meaningful alpha that's repeatable through a cycle, generate good income at a time where there's very little income, and look after people's portfolios and have capital preservation being the core. I guess some of that gets a little bit confusing for people to understand when they look at a strategy that says private debt and it's hoping for a 15% return. And then you look at ours, which is targeting 400 to 500 over, with 4 to 5% kind of returns. We're generating just a bit above that at the moment. How do you line those two up? We would say with a cash rate of 0.1%, and BBSW's collapsed to almost zero, and as Charlie points out, maybe we're staring down negative rates. Think about the risk involved in these strategies rather than just the return. So there's no such thing as a free lunch. So if you're generating 15 type of percent returns, you shouldn't be thinking about that in your fixed income and defensive allocation. That should fit firmly within your alternatives. Where we sit is where you can guarantee or you can actually say, well, through the cycle we're going to generate this income, but you need to give up your access to your money on a daily liquid basis. And I think that's where it's got to be. Really, what's on the tin is what's got to be delivered for your client.
Thanks for that, Bob. I guess sticking within a similar theme of, specialization, we all know it's fairly commonplace that many clients will seek out specialist managers in the more sexy, sort of growthier parts of their portfolio. So dedicated managers in global versus domestic equities, large, mid, small caps, emerging markets, long, short, REITs, infrastructure, you name it. But when it comes to us less sexy end, the fixed income end, typically, as we indicated before, it's been a composite or more aggregated manager. Do you believe specialist managers bring something extra to the table? And in specifically, why is that? Bob, I might start with you.
Sure. So most definitely is the answer to that. So, in being in the fixed income markets for so long and managing money for large superannuation clients, if I take the analogy of that they would maybe have one day of asset allocation discussions And generally, fixed income got the graveyard shift, which is usually 4:30 to 5 o'clock, because rates were much higher. They just said, well, you know, we got some government bonds, we got some of this, we got some semis. You know, we earn some carry, and it gives us insurance for the portfolio, and it's not correlated. Shut the book and let's go and have some drinks. Right now, those allocators are having a much bigger problem because there's no income. So I think it really does cause them to look at how do we actually generate the income for that defensive part of our allocation, as well as have the insurance of the non-correlated nature of what it should represent in a overall asset allocation piece. So I think, you know, the way that Charlie and I come at this, Charlie's really that insurance end, and if things get much, much worse, then, you know, that sort of bond portfolio really performs. And then we really fit the mold of the income side. So between those two allocations, you have some semblance of what that defensive allocation should look like. So it really does call for specialist managers with a repeatable ability to generate an active return above an index that can actually do it, you know, through a cycle, and not just at the best part of the cycle and then blow up, you know, as soon as things turn bad. So that's kind of how I think about things today and moving forward post, you know, 2020.
Okay, thanks, Bob. And Charlie, I think you and I have definitely spoken at length in the past about the dearth of quality sovereign managers, certainly in our landscape. So I was very happy the day I met you and you said that that's all you do and that's all you ever really plan to do. Maybe talk us through a little bit about your specific specialization, why you feel it's important to have a specialist manager in the sovereign space.
Yeah, look, I think it comes back to many of the things that Bob just echoed on, where there's a lot more to it than just this one size fits all fixed income allocation. And so we've always come at this that if active and specialized managers can really deliver excess alpha over time in each of the subcomponents, then compounded together through time, that allocation is going to be tremendously powerful. And I'll absolutely guarantee that Luke and the distribution guys will be able to provide you with data which will show you that by splitting the portfolio up and selecting specialist managers, it doesn't have to be Bob and myself by any means, but good, you know, and there are a number of high quality folks in this space, of course. There's not as many as there are in equities, but they are around, that you will have much better outcomes over time, and you will seek and get that you know, precision in your asset allocation that you desire. And so I think that that's the major kind of thing that we focus on, and we absolutely exist to try and deliver. As I said, a lot of people don't really sit around and think about their government bond allocations, but when they are allocating to a composite strategy, because the government is clearly the biggest issuer of debt in the economy, those indexes are about 90%-ish roughly government you know, backed, be that federal government or state government. And yet those jack of all trades managers tend to, if you look at the RBA holdings data, they'll have something like 50% corporate credit. Now that's a very clustered allocation in investment grade credit in Australia, because 60% of that is the financial system, be that, you know, the big four or the like. So again, it becomes, you know, very, very narrow allocation. It's a long way away from what it should really be. And we constantly see these periods where it's a mobile phone with no batteries, or a, you know, gun with no bullets, like we saw in March and April, because it's been misallocated. Now that misallocation will you know, patch over things in benign times, and you know, a lot of those lazier managers will have some alpha, but then as Bob said earlier on, you know, we get one of these episodes and the alpha's gone instantaneously and the whole structure is locked up. So we just really think that this definitely works through time. There is a multitude of research from far smarter folks than us that will suggest the same thing. And we can certainly provide you with some additional reading if that's of interest. But we fundamentally believe that, and you know, having you know, vast international experiences, this is the way it's done offshore in much more developed markets. And as Australia's fixed income markets develop and grow, you know, remembering that they were only $40 billion of government debt outstanding prior to the GFC. Now we just had a budget deficit of $216 billion in a singular year. So these things are growing pretty quick. That, you know, investors are going to learn a lot more about these subtext sector specializations, the way that different products behave, and the solutions that they can bring to portfolio construction in not only, you know, balancing off on other risks, but deriving that income and bringing that insurance and capital stability quality.
Mm. You bring up a really good point, Charlie, about, I guess, just the opportunity set itself. I mean, like Bob's asset class for a long time, it was completely bank dominated. And now increasingly there is non-bank participation. And as you rightly pointed out, there was a period in history where we were questioning, is there going to be a government bond market in Australia at all? And you could argue both your asset classes now within the domestic market are very viable and certainly growing, if anything. I guess my 2 cents to add to the manager selection piece is that in most of my career, I've been involved in manager selection in one way, shape or form. And I would agree with much of what both of you have said. It doesn't mean that there aren't high quality, high grade managers that invest across the spectrum, but it just simply means that those who are specialists, typically boutiques in their space, let's be honest, by definition, they are able to form deeper expertise. And as I find my client base becoming more and more sophisticated, they themselves are targeting very specific betas where they want to find specific managers to fulfill those allocations. And so I think the world is increasingly moving to a specialist model, including in very large shops who are building boutiques within themselves, to sort of combat that trend. Just conscious of how we're going with time, and look, I'm conscious we've covered a lot of ground today, and maybe we'll just tie it all together with a few sort of closing remarks on portfolio construction. One of the most common, and I guess the most difficult questions investors will always ask is how much money should I be allocating to various sectors, various fixed income allocations? And look, I don't have a great answer to that. It really depends on things that are very specific to the investor. We know what these things are: your investment objective, your risk tolerance, your liquidity tolerance, and of course your time horizon. But I thought I might just pose that last final difficult question to both our panelists. How much should investors be investing or considering investing in your asset classes? And how should they maybe broadly be thinking about piecing together that allocation puzzle? Charlie, we might start with you.
Yeah, look, I mean, everybody would think that any manager would say 100% in the product that I run, but I absolutely disagree with that. Clearly, we know that we have a role to play in the portfolio. And I do think that in conjunction with other, well thought out asset allocations, particularly in this defensive part of the portfolio, investors are going to need to make their own, assessment as to what they do need, how much liquidity they want to hold. I guess they really can't hold cash anymore. Cash has become uninvestable on almost every metric. Can some of these types of solutions be substituted in over time? But we've always been very honest about the fact that we think that credit is a wonderful product. We don't like investment grade credit necessarily. So I do think that what Bob does has a hell of a lot of merit, but it does need to be balanced out with what I do. And that's absolutely why we both coexist pretty happily, I guess. As I said, from many investors, it's really about finding that age appropriate and that life cycle balance. If you're a 30-year-old investor and you've got all the time in the world, you don't have a lot of fixed income in your portfolio, nor should you. But if you're 70 years old, well, then clearly that looks very different, and you don't have time to ride the cycles in the way that a young superannuant might be able to do. So I really do think that that's very much comes down to individual investor preference and need. We certainly try and offer a host of solutions with differing return outcomes, different volatility outcomes, but always with the central tenet of liquidity and those types of things. And so no doubt you can talk to the distribution guys about what that looks like, but we've tried to cover off on a lot of those things and build product that we believe can satisfy these needs on a go-forward basis in clearly what are going to be very challenging environments for income provision and the like, given where we've got to in the global banking cycle.
And Bob, any final words on portfolio construction?
Sure. I guess I agree with Charlie. So even more so in private debt. So we would say it's completely inappropriate and not the right thing to do to put your fixed income allocation in the illiquid private debt strategy in its entirety. However, we would say, depending on the individual investor and their view on what their liquidity needs are, that we offer what we would say is still genuinely capital stable and capital preservation being the core of our strategy, offering much higher incomes than what are available across the board in fixed income markets, with the ability to say, well, if you can tie up your money, you can get a better spread. So my view would be that when we first started our journey at Revolution some 3 years ago, we went out to clients and potential clients and said, would you like to lock up your money for, because that was a fundamental objection, for like a 6 to 6.5% type return. And many people said, no, we don't see value in that. We'd rather go out and try to get much better returns. As the market has changed and BBSW, as I mentioned, has gone from 2% when we first started to near zero today, that our 6% kind of returns, because we got a lot of times floors on BBSW at 0.5% or 1%, or at minimum we've been building in 0% floors in all of our deals, that we've been able to maintain similar sorts of yields, in fact increase yield in our most recent fund, that 6% is now almost viewed to be the 12% of old. So I think that's where the proposition comes, and if you can give up, as I mentioned, access to your money, you can get a much better income profile with that capital stability.
That might have to be the tagline of the day. 6% is the 12% of old. On that note, I might kindly pass back to Luke, who will, I guess, close out the event with some audience Q&A.
Fantastic. Thanks very much, Sue. And just a quick reminder to everyone on the call, you can submit your questions using the Q&A function at the bottom of your screen. Just a quick takeout from me. I guess it's really apparent that nature of if you can be a little bit more precise around your fixed income allocation and create some buckets, then you can sort of start to take advantage of things like the liquidity premium from private debt and still maintain that high grade liquid diversifying exposure at the other end of your portfolio. Question that's come through here is quite a good one, actually. So the question is, in my experience, having looked at a lot of fixed income managers, I've noted that a lot of them have struggled to add value in duration. Why do you think that's the case, and is it actually a repeatable skill set? And I just before I hand to you, Charlie, I say it's interesting because that's actually a comment that's been raised a number of times over the journey from some asset allocators that we've spoken to, who've questioned whether or not you can consistently add value from duration. It's something that we would argue quite strongly against, back against. But yeah, Charlie, if you want to add some thoughts there.
Look, it's not an easy thing to do. I guess I've been doing it for 22 years. So, look, it's challenging. I mean, you get nights like last night where we all of a sudden have a potential COVID vaccine and things change very quickly. Of course, recently we've had Donald Trump and his 140 Twitter characters, which can change things tremendously quickly and often in the middle of the night. So the way that I think that it must be done is it must be done with incredibly strict risk management profiles. And I only ever worked for one institution before starting business. And I got to play with very, very large portfolios through very unusual periods in history. And I got to turn up and do it again every day the next day. So, there's a lot of folks that I work with that I thought at times were better at it than I was, or were certainly a hell of a lot smarter than me, but they just couldn't manage their risk consistently to outcomes. And so I really do believe that is the thing that makes it sustainable. Ironically, with what we're going through at the moment, with regard to these huge government programs of issuance versus these enormous quantitative easing programs, it's actually a very rich environment for alpha generation for a duration manager. There's a lot going on. People forget that no matter how much debt the government say they're going to issue, it will clear on the day, regardless of what the nominal size is. Whether that garners a huge market concession or not, is another thing. Under the auspices of a big blue wave and Joe Biden would control every level of government in the United States, we would have had multi-trillion-dollar kind of programs that the government bond market would be asked to fund, and that's certainly why US Treasury yields were backing up. But yeah, it's not an easy thing to do. Like I guess certainly sometimes you can be very lucky and stocks can look stupid just by virtue of some of these things that do land in your lap at times. But if there's one thing I'd come back to say that how do we do it repeatedly, it is that risk management process which we're so strict on. For anyone that's followed us, you'd know that we have an almost perfect series of risk management outcomes with regard to drawdowns. We've only missed 1 month since inception in 2015. So we're very, very proud of that. And it's the thing that, that we keep harking back to, that, what happens we don't always agree with, but we do understand that the market is 100% perfect and we are most certainly imperfect. And it's the only thing that can keep us in the game is to manage that risk. And it's an accretive process. It's not about, spinning the wheel and hoping for red or black. It's about going about it in a, boring and accretive manner to drive those outcomes over time and get to those, our performance targets that we're trying to hit, slowly but surely.
Thanks, Charlie. And there's a question here for Bob, which asks, Bob, 2 years ago, I'd never heard of Australian private debt. It seems like since then, that's all that I hear about. Is that a warning sign, or how should I read that?
I think I agree with you. I've been involved in private debt markets for pretty much my whole career, some 28 years. I guess the issue here is one where there's been a proliferation of many different type of private debt managers. And each one of them is quite different to the next one. And really the reason why you hear so much about it is because the banks are retreating because of global banking reform that I mentioned earlier in the webinar, that this is really starting to become an interesting topic. But I would say that there's not too many managers who are setting up that have got the experience in actually managing funds in the space. They might have come from banks typically, where they're more originators and originator deals to throw into a big machine. If it goes well, great. If it goes not so great, some other workout team has to go and fix it up or try to get the money back. And like I always mention that, you only get to say yes once. Once you're in the deal, you buy and hold, you're stuck in, whether it's a nice drive down the freeway or whether it's a bumpy road over a massive gorge. So the kind of issue here is making sure that you have the right manager selection, that they've got the skill and experience to navigate through a full market cycle and preserve capital. Because everybody will tell you that they're good lenders and they can get their money back. If you raise capital, you can go down George Street or Collins Street and hand out money. It's how you get it back and the way you have discipline in getting it back that really does come to the fore in these sorts of strategies.
Yeah, thanks, Bob. We've got a few questions still here, and we might not get to all of them, but there is one more that I'd maybe like to just finish on. And we've had some discussion around this already, but the question's around what percentage of total assets of a balanced funds should an investor allocate to government debt and private debt respectively? And I guess we can assume that in a balanced fund, you were talking about 30% of the portfolio being fixed income. So of that, how much should investors be thinking about allocating to govies and private debt? And maybe just following on from that, Sue, you also mentioned Mercer sort of splits out their fixed income universe into defensive fixed income and growth fixed income. Maybe be also good to hear about how you think about how much you allocate to those two different parts of the fixed income universe. But maybe we can start with Charlie, if you like, or.
Yeah, sure. So look, I guess assuming balance is around 30% fixed income weighting, I think that there's really roughly kind of three types of fixed income, which is what I do, which is the government only piece, that middle ground, which is that's where most of the product resides. We actually don't like that piece. And then what Bob does, which I think is a really exciting and attractive piece. So look, in very simple terms, 10%, 10%, 10% is probably a pretty good place to start, and then work backwards to what your actual needs are. What is fixed income doing in that portfolio? What is the other 70% that's not fixed income actually doing in that portfolio? If we look at some endowment data and the like from Europe and the US, you'll see that a lot of people miss that middle listed space because they don't like the valuations or the volatility that it brings, and they tend to have a slow but continuously compounding piece of capital and some defensive assets, and then load the other end of the spectrum with private equity and venture capital and things that they can make enormous returns or get huge tax losses on. And so there's a lot of different ways to go about it, but I think that it's a starting position obviously, it's a very different outcome depending on investor motivation and need. That's a pretty sensible place to start, I think, and I don't think anyone's going to use a singular manager. So you probably want to space that out as well, just to make sure that you do get a good cross reference through each different product, and you're going to be in really good shape if you can do the work and go to that level of granularity. I think you'll find your outcomes are really, really good.
And from my perspective, it's probably opening up a can of worms. You could almost have a new webinar on, but Australian balanced portfolios are not very balanced, because you say on average they're 30% fixed income. You've got an aging population. You've got people who are entering into periods of their life cycle where they can ill afford drawdowns. You need to have a higher allocation to your defensive asset class. But if it is 30%, that's a constraint, because I may never win that argument because of Australian love affair with equities. Then I think 5 to 10% is an appropriate allocation, depending on your mix and sort of liquidity constraints of the overall portfolio.
And I guess the only thing I would add to that is, rather than taking it purely from a fixed income versus other asset class perspective, another way to think about it would be your traditional growth versus defensive split. And this is where I was speaking about earlier, where Mercer sees certain fixed income asset classes, like what Charlie manages, to be firmly in the defensive bucket, and other asset classes, for instance, like perhaps what Bob's investing, to be more in the growth year end. And both have a place. In terms of an actual allocation, rather than give specific numbers, I can certainly say that Charlie's probably been bearing the brunt of a deallocation away from his specific asset class. Although, to be fair, it is still very much serving its purpose, as was proven in March this year. And I think Bob's been a bit of a beneficiary in terms of asset flows into that piece, and that's very much been driven by the need for yield, the need for income, and just where valuations are. At this point, anything that seems to be giving you a fairly secure income, a fairly secure yield, is clearly what's attracting client flows, and anything that I guess is looking like it's heading towards a zero, a negative yield, is clearly doing the opposite. And so I think it's up for each individual investor, balancing those criteria that I indicated before: risk tolerance, liquidity tolerance, objective, time horizon, to work out, your allocations. But I guess the other thing to think about is, if something's going to be such a small allocation in your portfolio that's not going to make a meaningful sense, then really why are you bothering as well? There's an element where, we do go down at times down the path of having too many tiny little allocations as well.
Yeah. Thanks, Sue. I think it's a really great note to finish things on. So hopefully that's been a useful and interesting conversation for people. I know fixed income portfolio construction is still a fairly difficult one for a lot of people to get their heads around. Thankfully, there's experts like Sue out there that can help you with that journey. But yeah, hopefully there's a few things in the session today to think about and help you along. We'll be sending out a copy of the presentation and a recording to everyone, but please feel free to reach out to any or all of us with further questions, and we look forward to catching up with everyone in the new year. Thanks very much.
Thanks, everyone.
Thanks, everyone.